Good day, viewers. Firstly, Happy New Year. I'm very glad to be back with all of you as we are very excited to have a look what 2024 has in store for all of us, specifically focusing on listed property. Given the recent market conditions over the last few years, there's been an increased interest in alternative products, including hedge funds. Therefore, we at Catalyst have decided to create a dashboard for you, our viewers, that specifically focuses on our two hedge fund products. The underlying building blocks of these two hedge fund products are listed property. I am Binette van Wyk, Chief Operating Officer at Catalyst Fund Managers, and this morning I'm joined by Marcus Erlang, the Portfolio Manager of our local hedge fund. Marcus, the track record and the history of your fund speaks for itself, but I think our viewers are very keen to learn a little bit more.
Thanks, Binette. So the Catalyst Alpha Prescient QI Hedge Fund was formed in 2005 with a mandate to deliver the best risk-adjusted returns using local listed property and global listed property as its tool set. It's a variable bias long-short hedge fund, and I think even though it has the potential to go long-short and be equity market neutral, net short or net long, through time, the fund is generally run with a net long bias. It tends to operate between the sort of 40% and 90% net exposure, depending on where we see value in the market. And I like to always refer to how the fund is run in a three-siloed approach. You've got the local listed property, global listed property, and then your cash and cash equivalents. Local listed property is obviously your SA-centric, JSE-listed property stocks. Global property is your Rand hedge stocks. Those are offshore stocks that are listed on the JSE, as well as direct offshore stocks that the fund can hold directly. And the fund also invests a portion of its AUM into our global qualified investor fund, which is a similar product that runs alongside our local hedge fund that focuses only on global developed market REITs and listed property stocks, and is run very similarly in a net long bias. So the local fund, it's very efficient for the local fund to get some of its offshore exposure by investing into the global property fund offshore. So in a nutshell, that's what the fund is all about. It's got a 20-year almost track record of delivering exceptional returns on a risk-adjusted basis to clients.
Marcus, if we look at your fund's track record, it really is stellar. I would love for you to touch on that, maybe talk about the history of that performance, but then more recently, 2023 was also an exceptional year. Maybe you can elaborate on that, on 2023 specifically, and add some flavor to your answer in the sense of what contributed to that success.
All right, sure. I think first and foremost, like I said, the fund has a track record of nearly 20 years. It was formed in 2005, and over that period, the fund has delivered a return in excess of 16% annualized per annum at a far lower volatility than the underlying indices, which are the ALL-P and the FTSE Epenari Developed Rental Index offshore. I think if you look more recently at the 2023 year, the fund has delivered a return of 15.7% after fees, so net of fees, whereas the All Property Index delivered a return of 10.7%. Once again, the fund managed to do that, keeping net exposure in that range of about 50 to 65%, which allowed it to deliver those returns at a far lower volatility than the underlying index. Some of the things that have allowed the fund to do so is, firstly, the fund is a 400 million roughly fund, 400 million Rand fund. So there's a handful of opportunities within the SA listed property sector which are considered small caps. So they have a market cap between 2 billion and 4 billion Rand. And due to the nature of the size of the fund can actually take a meaningful position in some of these positions. They tend to provide outsized performance because they have a bit of a liquidity premium attached to them, which for a smaller hedge fund isn't as big a concern. We can still easily get in and out of the positions based on the available liquidity that there is. And these companies tend to have often very entrepreneurial management teams that intimately know their small portfolio of assets. They have a very specialized strategy, and the companies tend to be able to finance it in a very vanilla way. In another way to say that is they don't have complex offshore structures to artificially boost their earnings. So the fund tends to, from time to time, take positions in these small cap stocks, and they've been largely successful in 2023. Another thing that the fund has managed to capitalize on is the extreme volatility of the markets in 2023. I think a hedge fund is, volatility is your friend to a large extent if you are able to get your exposures and your stock picks correctly. So through October, the ALP was down 10% towards the end of October when sentiment was really negative. And in that period, the fund had a lot of positions short, which it closed, and subsequently went long to be able to increase net exposure and then capture a lot of the upside in the final 2 months of the year. In that way, the fund can actually benefit or deliver alpha on both the drawdown period of these stocks as well as the recovery period of the stocks. So you can actually generate good alpha from stocks even though the year-to-date or 2023 return in total was negative or tepid. So the fund managed to capitalize on a couple of those opportunities. Thirdly, the fund was on the right side of a lot of corporate activity. Early in the year, Industrials REIT got taken out, Liberty 2 Degrees got taken out, and later in the year, Hammerson rallied on talks of them exiting their low-yielding value retail subsector or portfolio. They're holding in the value retail, which is immediately accretive. And I think it's important to note that the fund will never take a position in these stocks based purely on takeout odds or corporate activity odds. The fund takes the position based on there being an intrinsic value in the stock, and then when it gets taken out, it's just an additional sweetener that contributes to fund performance. Another thing that the fund did quite successfully is during the year we noticed that your cash in overnight, so just sitting in the fund, was generating about 5 to 5.5%. This is your working capital cash that sits in the fund to be able to deploy into opportunities. But there was actually an opportunity with long bond yields in South Africa yielding between 11 and 12% to maturity at its highest. So instead of having the cash drag of your overnight cash, the fund decided to place a large portion of its sort of not immediate required cash into a suite of enhanced cash accounts. These enhanced cash accounts throughout the year delivered a return of around 10 to 11%. So you were able to maximize your cash equivalence balance without meaningfully going up the risk curve. And then finally, I think a differentiator with our fund is the ability to be able to tap into those global developed markets. In South Africa, you've realistically got about 35 to 40 investable stocks in the sort of the listed property space. But offshore, you've got north of 300 stocks across 15 developed markets, across 12 to 15 subsectors. So not only do you have much more optionality, but the conviction on putting together pair trades is that much higher because you would have, for example, 2 stocks both in the United States single-family housing subsector that you can then pair them against when there's pricing differentials and take advantage of mispricing opportunities as and when they come along. So I think those things, long story short, those things have contributed to alpha and allowed us to meaningfully outperform the all property index at a far lower volatility. I think it's also important to note that while it is very pleasing to have such a strong one-year performance, we do value our stocks on a long-term time period, 5 to 10 years on a discounted cash flow methodology. So we like our investors to have that sort of at least that sort of an horizon if they invest in our fund. And a mark to the success of the fund is that it's never actually had a rolling 3-year period delivering negative performance. So I think having a always positive 3-year rolling performance since inception over 20 years is a great testament to the ability of the fund to protect capital in a negative cycle and then to maximize absolute returns on a risk-adjusted basis when the recovery comes.
Marcus, really well done. But I mean, it talks testament to this toolbox that you have and how well you've optimally used all of these tools in your box and delivered such a great performance. I think let's take a moment to look at what 2024 has in store for us. How is your fund currently positioned? And also share with our viewers what your outlook is for the local and the global property sector over the next 3, 4, 5 years.
I think it's probably a famously overused way to put it at this stage in the cycle, but I would say that we are cautiously optimistic. I think fund managers are always happy to sit on the fence a little bit when it comes to these kinds of questions. But I do think that the fund at the moment is actually positioned quite near its long-term average, that being around 65 to 70% net exposure. Through the drawdown period of September and October, the fund did meaningfully increase exposure. And through the last November-December period, where from its lows, the ALPI has rallied nearly 20%, a couple of the chips have been taken off the table. Looking forward into 2024, I am optimistic. I think there is green shoots of some optimism filtering through back into riskier asset classes, specifically listed real estate. But I'm also cognizant that you just have had a 20% rally, so it is prudent to protect or to lock some of that in. I do think the outlook for the first half of 2024 is probably still going to be volatile. The market maybe got a little bit ahead of itself now on excitement over rate cuts and excitement over inflation coming under control, but I don't think it's completely final yet. In addition to that, I think a lot of the companies still have to release H1, half year 1, 2023 results, where it'll actually be the first period where they have the full extent of the higher rates in the base. So I think where the optimism will start to creep in is where A, there's a little bit better clarity on exactly how the rate cutting cycle looks and when it starts, and B, when the companies release H2 2024 results that actually guide to a 2025, which has inflationary type, inflation plus growth. So I think the volatility, once again, the fund is going to be cautious and not completely go all in as of yet. I think there'll be an opportunity for that later in 2024. And I think on the global side, what's quite important to note also is that globally and locally, I imagine actually is that in the rate hiking cycle, listed real estate tends to underperform due to the inherent debt that is held within the sector against the assets. And historically, listed real estate has outperformed in the cutting or post the peaking cycle. Now, if you look at general equities offshore, you know, the S&P 500, the NASDAQ, they are all at or very near their all-time highs, whereas listed real estate is still about 20 or 25% off its end of 2021 highs. So I'm optimistic that there'll be a little bit of mean reversion such that listed real estate gets a little bit more of the so-called love going into the tail end of 2024, and that they can close the gap on their more general equity indice counterparts.
Marcus, we appreciate your time and your cautious optimism, and we look forward to learning more about the hedge fund property offering at Catalyst. Viewers, thank you so much for tuning in. If you'd like to learn more, please refer to the first Alts dashboard, which will be the Q4 2023 dashboard. Or alternatively, please reach out to Marcus or myself as per the contact details below. Thank you so much and goodbye.